Juliette, fabulous to see you as ever.
Great to see you too.
There's a lot to talk about, and I think we're going to have some difference of views, which is great. So let's start with, what is your macro backdrop right now?
So I just came out today, actually, with a new report, which is called Putin Steering Macro Storm, which I hesitated to call calling steering a macro shitstorm, but I thought it would be on PC. And the subtitle is a recession evitable? So I think it summarizes well what my macro backdrop is at the moment. I think in Europe, recession is probably inevitable, but we can probably avoid a global entrenched recession thanks to the continued strengths of the US economy.
So let's talk about the US first, then we'll go around the world a bit. So talk to me about your US backdrop and what you see happening there, what the risks of recession are, the inflation story, how that's playing out in your head going forwards, that whole structure, because that's what everybody's struggling with right now.
So in the US, as opposed to in Europe, what's really been interesting is that we have had a price wage spiral. So it means that, even if obviously there's like the initial inflation shock, which is extremely contractionary, you then have the wage increase, which gives a bit of what I call and many call like the nominal illusion, which is that basically you're seeing your nominal wage increasing and you're basically incentivized to bypass the inflation shock by actually borrowing. So what I'm seeing really is a new equilibrium. And, I don't know if you remember at the beginning of the COVID crisis, where, there was just a hint of, people potentially missing toilet paper. And obviously toilet paper never really went missing, but everybody just piled up on toilet paper and was left like 6 months later with like 20, 40 rolls of toilet paper. So we got to like a new equilibrium level. Well, that equilibrium level is a good picture for what's happening everywhere else in the US economy, meaning inventories are being pushed much higher than where we were before. And it's not a bad thing because, you and me have never actually had to analyze an economy where there is inflation. But when there is inflation, the first thing is actually inventory costs are down dramatically. And in fact, you might make money on high inventory beyond the fact that you actually want to guarantee your production. The same thing is actually true for employment because, as we well know, employment can drop down really quickly when there's a shock on the economy and no inflation, because you have to cut your cost, labor cost, by actually laying off people. In an inflationary environment, you can just basically freeze salaries and actually cut your labor cost without firing anyone. So it's much more difficult to bring an economy where there is inflation down. And that's really what I'm seeing in the US, where the credit impulse is still, it's turned obviously, but it's still at a very strong level. Banks are lending happily. Consumers are basically able to subsidize the cost and the purchasing power drop from inflation with higher credit. And, everything else equal, that could be sort of like the bridge to eventually higher wage and lower inflation. And that's what I'm saying. That's basically what I'm saying in the US right now. Now, obviously, there's other shocks impacting the rest of the world, which matter a lot for the US as well.
Are you picking up demand destruction yet from these higher prices? Because obviously wages and corporate profits aren't keeping up. Corporate margins are under pressure from this, and we're seeing wages obviously below the rate of inflation. So real wage growth is negative. Are you yet picking up kind of demand destruction going on?
In the US, not really. I mean, apart from like the obvious slowdown that you're going to get from like the post lockdown, the normal kind of like slowdown you would get after 18 months cycle, which is just totally normal. But yeah, apart from that, really what I'm saying and what's really interesting is that, and that's something that you can look at yourself with Conference Board, is actually spending plans are actually going up with exactly with like about like 3-6 months lag, exactly going up with short-term inflation forecast, short-term inflation expectations. So you've had like inflation expectations shooting up, to basically like 40-year high. On the back of that, spending purchase plans are also shooting up to like 40-year highs, and there's basically zero correlation with real wages. So I think there is an expectation there that the best way to actually, go ahead of inflation is actually to borrow. And it is actually macroeconomically, it makes complete sense. The only way you can basically fund your way out of this current crisis is by borrowing. And anyone who's borrowed in the last 2 years is a complete winner. I mean, you can borrow at any level. If prices are going to go up like 10% in the next year, if you believe that prices are going to go up in 10% in the next 2 years, 1 year, then it makes complete sense to borrow at 5%.
And what's your view on inflation in the US, let's say first? Does it remain sticky? Does it come off? How are you thinking of this?
So the way I'm thinking about that is, in a normal macro world, inflation would have already come down a lot. And that would be the normal sort of balancing mechanism between, demand shooting up, inflation coming up with demand, and then, demand would start slowing down. And suddenly you would, sort of like equilibrate everything by the end of the year. And, wages, it is completely normal that wages are lagging inflation. I mean, you're only really getting bargaining power after inflation's already happened. So I think, it would really make sense that this year, we are seeing the wage growth on, around like 7-8%. And by the end of the year, you basically get inflation at like 4.5%. And suddenly you're actually regaining purchasing power, which is, the lag is actually quite normal so far. And I think there is a turn already. You can actually already pinpoint a turn in purchasing power. But obviously, the issue here is what's happening in Russia and the Russia-Ukraine conflict, and the fact that it's keeping the war premium on commodities and obviously inflation much higher than we would be in a normal sort of like free market macro equilibrium. So, and that's unfortunately, what happened in the 70s. That's also what happened in 2008, 2009, where basically commodity prices, inflation stayed way too high for way too long. And basically macro forces couldn't, balance. And that's how you end up into a deep recession. So that's where I am right now. I expect inflation in the US to come down, but to remain sticky to the top side, depending on what's happening in Russia, Ukraine. I actually think, commodities will stay higher much longer, but there will be, I actually think the dollar will go a lot stronger, and that US will start importing disinflation in the rest of the year.
And so what does it mean for the Fed and for yields in the US?
So yields in the US, so my view is that you could, if you're looking at like a Taylor rule sort of like model, which, maybe a lot of us are laughing at, but when you think about it in the framework that I just described, it's exactly the right framework to basically look at an economy, analyze an economy where there is inflation, because it's actually taking into account the fact that inflation is an extreme stimulant. You would be basically getting to like yields, equilibrium yields at the moment of say 6%. And that's assuming, obviously, that inflation is already coming down from, like the current, like above 7-8% to like, 4.5-5%. The problem is we're not at the moment in the world where US is on its own. Global growth is becoming extremely desynchronized because of what's happening in Russia. As it happens, many macro pundits believe that Putin is losing the war in Ukraine. But what's clear is that he's actually winning the economic war with Europe, and that basically Europe is on its knees on the back of like extremely high energy prices, which means that we're not in the world we were in like pre-war, where basically the world was firing on most cylinders. I did expect China would be, the Chinese slowdown would be entrenched into the middle of this year. So I'm not really surprised by that. And I think it would potentially be a blessing in disguise, because what we really need is like lower global demand. But the problem is this, war premium in Europe is an extreme issue at a time where economies are fragile and there is no quick fix to it. So when I previously expected yields to go a lot higher, e.g., potentially I was targeting like 4.5% on 5 year. I've actually now gone long 5 year and long duration. Now expecting that the financial tightening that I thought would be necessary to dramatically slow down the US will actually move to like basically a stronger dollar importing disinflation, and basically that takes us like in euro dollar below parity, and that means also that all else equal, US rates are not going to be able to move to the previous equilibrium.
So where do you think they peak out? Let's say 10 years, the 10-year rates.
I think we've probably peaked, in the next 25 basis points. And given the high carry, I think it makes sense to start going long duration here.
And what about the Fed? How far did the Fed actually manage to go? Or I'm kind of thinking that monetary conditions have massively tightened because of the commodity prices and the rise in prices and the dollar, and the rate market, already did the work of the Fed anyway. How far did the Fed actually go?
I mean, in this sort of environment, I kind of like to focus on the trades rather than how far the Fed will go. I think, on 5 year, 10 years, we've, reached, where the Fed will actually get to go. I think,
it doesn't matter because it's discounted by the bond market anyway.
Yeah, I mean, I don't really. People are always trying to push you to be like, are they going to do like 25, 50 next month? What about in 2 months? And the reality is like, I try to really focus on where I've got an edge, a macro edge, and I don't really have a macro edge on what point the economy is actually going to be like rolling over fast enough that the Fed will realize that its employment and growth mandate is becoming more of an issue than the inflation mandate.
So the trade in the US for you is remaining long the dollar,
yeah,
and probably buying bonds.
Yeah.
What about? And do you think we're going to get to recession in the US? Or are we just having a growth shock? ISM down to 50, which is pretty typical after a post-recession. You usually have a post-recession pickup. It tends to settle back down because the stimulus is gone and then kind of stabilizes. Is that what you're thinking, or are we going through a full cycle?
So I really don't think that we're headed to like an entrenched recession globally, thanks to the US actually, thanks to the strength of US demand. I do think that we're probably going to see an ISM number like below 50 because we always get it and then gets everybody excited. You get the next sort of like 5% down in SPX and that's what you buy, and then you're basically getting in the next sort of like mini cycle, or what you call intermediary cycle. In my analysis, we're not late cycle, we are mid-cycle. And the way I look at it is, the way I like to picture it is by looking at the real curve and the real curve shape rather than the nominal curve, which in my book makes no sense at all here because it doesn't take into account inflation and the fact that inflation is a high stimulant. So if you're looking at the real curve, like 530s, we've moved a lot in the last months. We've moved basically 40 basis points, but we're still at 85 basis points, which is still very much pointing to mid-cycle. And the reason I strongly believe that is that wherever you look in the US, private leverage is actually quite low. It's a lot lower than where we were pre-GFC. And one of the bonus of the COVID crisis is that basically all the private leverage have basically been transferred onto public balance sheet. Whether you like it or not, it's actually a source of future strengths. And the reason why households are being able to continue to leverage up, and why I don't really believe that it will collapse anytime soon, especially if we actually do get continued employment strengths and wage strengths as well, which is highly possible even in a slowdown because of inflation and the fact that I mentioned before, which is basically the employment market is a lot stronger and a lot more difficult to break in an inflationary world.
Yeah, I'm struggling with the same. I'm not sure of a US recession yet, and if it is, it feels like something mild and short. I can't tell. I'm not even sure whether we've got the same length of cycles anymore. One of the things I've thought is that great moderation period over, which were these long, slow, damp cycles, and we've now got these shorter, sharper cycles, which we used to see prior to 87, I guess, before Greenspan started becoming more active with interest rates, because nowadays we don't really have interest rates to use as much. So we have, balance sheets basically and fiscal. Yeah. What do you think? Do you think we've got in the same kind of great moderation cycle, or have we structurally changed the economy somewhat?
I think everything has changed, and we're way beyond moderation. I think what's really interesting in terms of the length of the cycle is, over the last cycle, we basically had run out of monetary space. Now we still had a lot of potential for counter-cyclical tools in the sort of MMT fiscal tools. But I think we all knew that the free lunch would only be there until inflation popped up, basically. And now inflation has popped up. And that's where we are right now, where we have basically no monetary tool outside of the US. There is obviously a lot of potential for a monetary policy to actually work as a counter-cyclical tool in the next sort of mini cycle. But in Europe, this is gone. You've got basically no monetary tool, and you've got also no fiscal tool. And I think one thing that I really want to mention in the sort of move to we don't really care about Putin, and we're going to win that macroeconomic war by sending out fiscal checks and what I call inflation checks. Well, this is not going to work. I actually think we as people if we want to win this war, we're actually going to have to take some serious pain because you don't fight an inflation shock with inflation checks. And I think there is going to be needed to be a belt tightening in terms of energy consumption. And there is going to be some serious decision to be taken in the next months, in the next 2 months. And, unfortunately, there's Boris Johnson in the UK is sort of in a pickle politically, and France was in the middle of a general election, a difficult one. So I think there hasn't been a time where anyone really was able to take make the right decisions. But I think the right decisions are going to have to be ahead of us, and the buying, there is no way to buy yourself out of this crisis, and so there is going to be belt tightening.
One of the things I've been thinking about in the belt tightening in the European situation is transfer payments to households, whilst energy rationing to large energy users. How are you thinking they're going to structure some of this? Because I don't think they've got the stomach to let households take the pain, but they might be able to let corporations take the pain.
Well, yeah, but the problem is then you're not really lowering demand, and Putin is winning this war. And if you look at euro ruble, sterling ruble like chart, you can see exactly who is winning the economic war. And it's not Europe, it's not UK. In terms of what I would do, I think you really need to focus on the most on sending those checks or subsidies or tax cuts. You really need to focus just on the most vulnerable part of the population. You can't continue to subsidize the rest of the population, because you need demand contraction. And whether you're looking at like the green transition that everybody wants, or the war, Russia-Ukraine war, what really is obvious is, energy consumption is the big elephant in the room, and that needs to come down. And for me, there needs to be like a realization that you don't win a war without a war effort, and the war effort is basically basically turning down the energy consumption for not only corporation but obviously households as well.
So, as you rightly said at the beginning, this sounds like it's becoming a shitstorm for Europe because there's no way out, right? So, as you say, they need to lower energy demand, which is general demand in the economy. They've got no monetary policy to use. Fiscal sounds, yes, maybe at the margin is what you're saying to the poorer households. So Europe just goes into full hard recession, right?
Well, again, I think, you still have the escape valve. So you don't have a monetary of the euro. Yeah. So for me, I think it's potentially the saving grace. If US is able to chug along and euro goes to like below parity, then suddenly, later in the year, I can already see like reason to think that Chinese demand will basically bounce again, and obviously that will help in terms of like cyclical, Germany, France, and generally Europe, which is much more sensitive to global manufacturing, to the global manufacturing sector. So I think there is a way out. There will be a severe recession, but again, I don't think it's one that has no exit door as long as the US can hold on.
And it doesn't feel, and I don't get a sense of this, that there is a financial risk here. It feels like a kind of ordinary recession, if that, like the 1990 style recession, which is a recession that lasts, a few quarters. Yeah. Yes, it can be reasonably severe in Europe, a slowdown in the US, but doesn't materialize into anything more structurally concerning. Is that how you're thinking about it as well?
Exactly. Yeah, that's and part of it is obviously the strengths of the employment market, which I see holding on, but of course, as we both know, that's a deep lagging indicator. So is inflation as well. But so that's one important one to monitor. Obviously, if we see retrenchment on the employment side, then we're talking a complete different story. But that's not what I'm seeing right now.
So how are you trading the euro? You're obviously short euro. It's getting pretty extended, so it's not as easy a trade as it was. What are you thinking? Do you think it just continues to grind lower, or we get a period of consolidation first and then a push below parity? How are you thinking that through?
I mean, I don't like to play grinds. I think, when markets are going somewhere, they go there and like very quickly. I actually expect, we are at the very key level here. DXY is basically about to break, I think like 5-year consolidation range, if it's not more than that, right? I actually think we're going to go through and then, there's like 5-10% to get, whether you buy one touch in the next 2 months. But, I never look for a grind when something looks like it's happening and it's got a reason to happen, there's no reason to hold off. So that's the way I'm thinking.
So you're thinking that there's going to be a continued sharp move higher in the dollar, and that itself is a balancing mechanism, I guess.
Yeah, and don't forget, when vol like starts to expand, I mean, we currently think, it's a big move because we've basically been like for the last 5 years with no move in whether it's in euro or yen. I mean, what's the number of like FX desk that have closed in the last 5 years of FX hedge funds, because there was no volatility. Suddenly volatility is there. The last thing you want is to start fading it. I mean, when something's happening, the last thing you want is to basically like sit back and be like, what, I'm going to be selling rallies. I think, you have to be in it and, with a stop and that's
what about the idea that the Europeans could, and they kind of pseudo do it anyway, but go the full Japanese route of yield curve control? So they're saying, fine, we'll take the pain. We understand it's inflationary. We're not going to get bond yields to rise. Do you think yield curve control comes into Europe?
No, I really don't think so. I mean, what would be the point of it? Just to weaken the
stop yields rising
faster?
Yeah. If that's the escape valve, because I don't think Europe can afford bond yields to go higher because the banking sector is still pretty shitty, right? And it's difficult to raise. You don't want rates to go too high in a situation like this. You want to get demand destruction, but you need to buy yourself time. Don't know. It's just an idea.
Yeah, I really don't see it. I mean, obviously, the bind at the moment is that inflation is so high and they can't actually do anything against it. So I think, going YCC would be like very drastic, like a super dovish move. And I think they're sort of trying to stand in the middle, like, buying optionality rather than, moving it drastically. I mean, I think their favorite scenario would be to be able to deliver the hikes that are priced by markets, which is, I think, is like 90 basis points by the end of the year, which seems enormous when basically you're headed to like a severe recession. But I think they're just trying to buy optionality, see what happens in Ukraine, which is absolutely key. And really, I mean, for me, the key to the macro outlook is really put in what's happening in Ukraine, the war premium. And for me, it's much more difficult to, like, we used to have like a geopolitical movers like, Trump, who used to like, drop bombs in the market. And it was really easy to analyze because he's never really done anything that would change cycles, right? So you could use the noise around the underlying macro trends to basically take as a massive opportunity. The problem with Putin is that this war can actually be entrenched. The war premium can stay high for way too long, and that can actually change the macro underlying trends as well.
I mean, there seems to be about a zero chance that he leaves. So I don't know what changes here. I mean, I don't see anything changing.
I think for me, his game is basically to win the economic war with Europe. Who is going to be able to stay longer? At what point, basically, European leaders be like, you have to let go of Donbass, and then basically, I think what Putin wants is not to win the whole Ukraine. What he wants is basically to put a hand on the commodity markets and basically have control of full commodity markets in Europe, which is a massive win for him. I actually think that's the aim of the war. So that's my worry here, really, is that he's basically getting everything he wants.
But Europe is transitioning, right? But it takes time. I don't know. I think this will accelerate the transition, but it's still until the end of the decade before you can really start denting demand properly for fossil fuels.
Yeah. I mean, the other way, from what I looked at, the way out is basically, importing gas from Algeria, importing gas from Canada. There is a way out if you start, reining in, basically cutting down consumption, even marginally. Even 10%, as makes a massive difference on commodity markets that are supply constrained. So I think there are some way out, but it needs to be acted on sort of like, yesterday, not like and in the next month, certainly, rather than, looking at the next 5 years.
Yeah, I've been focused on Algeria because, it's right there. There's pipelines to Italy. Spain and Algeria keep fighting over Western Sahara. But if that can get resolved, then you can get gas pipelines running into Spain, gas pipelines running through Italy. And, that's going to help at the margin significantly. But again, that's not an instant turn on the taps.
No, it's not. And unfortunately, that's why the slowdown is ahead of us in Europe, and there's no quick fix. And unfortunately, I very much believe that it is Putin's aim, and that there is a chance that he will win that economic war, and that European leaders will just have to push to have like a Zelensky let Donbass go, and
Yeah, that's been my base case for a while, that he splits the country into two, kind of neutralizes the rest of Ukraine.
Which is a disaster, really, but yeah.
Yeah, but, what else? Nobody wants to go and have an actual ground warfare with Russia. So it's very difficult to resolve. What do you think happens to bond yields in Europe? Are we peaking there as well?
Well, I mean, if I'm long US here, I'm not going to say like anything else than, but I prefer to, for me, the superior trade is to look at Euro going down rather than, picking up some boons here. Obviously, I think at the moment it's ridiculous to think that the ECB will be hiking 90 basis points by the end of the year. But obviously, inflation wise, if suddenly you sort out the Russia side, by some sort of like miracle, then, yields could go a lot higher. So that's why I prefer to look at the Euro side, which seems like a much better risk reward trade.
What about equities? Are you seeing any opportunities in equities? Obviously, they're discounted a reasonable amount right now, down, 20 odd %. It's kind of in the right zone. Do you think there's much further downside, or are we kind of towards the end of that move?
So in equities, the crazy thing is like Europe, as you say, is already discounting like a severe slowdown. We are close. I mean, in fact, I've already recommended buying Europe, on 8th of March, just because, whatever happened, it's just like sort of like either you get nuclear bombed or you own equities at a really good levels. So, but I'm looking to build on dips of like sort of like 5% dips. Same thing in US. I think SPX could go to like 4,000, but I don't see it go a lot lower because of my view that we are not going to get, it's not the end of the business cycle. It's just a slowdown, which means that, there is light at the end of this really obscure tunnel. And even if you look in terms of like world indices, there is probably like another 3-4% to go. But if you go like towards like another 10% dip from here, it's a massive buy, in my opinion. So it's not the way to trade the upcoming recession.
I've been doing the same. I've been buying the weakness here because even it almost doesn't matter the semantics of if this is a slowdown or a short, sharp cycle. I'm kind of thinking we do more of this. Either way, that kind of non-structural recession, as you're talking about, we haven't got a global financial crisis here. These things don't last long. Usually the sell-offs are somewhere between 20 and 30%, which is kind of the zone we're in. So it feels that you need to be accumulating, because I think we get demand destruction. And so we get an economic slowdown, obviously, and that leads the interest rates to fall, and therefore most of the growthy end of the market and stuff recovers. And let's see how households do in this. It's not clear yet to me. And I think you're right as well, is we got to keep an eye on China, because China led all of this slowdown. It was written there 18 months in advance. It was just, it was obvious. All of us in macros like, well, we're going to have a massive slowdown because China's doing it. And it looks like they're starting to stimulate now, and the credit growth cycle is about to turn up again. And, that takes a bit of time. It's 18 months away from the low. If the low was, 3 or 4 months ago. So it takes another 18 months before we start seeing it. But let's see whether Chinese get through a full cycle. Do you think the yuan weakens? We haven't talked about the yen and the yuan because that's the other interesting macro setup going on. What do you see in that situation with the Japanese yen?
I'm talking about like a dollar broad-based move, and I don't see anywhere the yuan wouldn't weaken much further than. I mean, for me, it's been a big conundrum, and that's the issue with sort of those leading indicators that are leading by like 12 months, and you're like, okay, this is going to happen next year, but I should actually not look at it because it's not tradable at the moment. So yeah, I've been really surprised this year until obviously like this month by like the strengths of the yuan, and I'm very cognizant of the fact that Chinese are worried about having the yuan. They want the currency to become sort of like more of a reserve currency, and it makes sense that monetary authorities in China have their hands tied when there's such a big discrepancy between what's happening in the US and what's happening in China. But in the end, it will be the escape valve as well. And I think it will be a blessing as well because it does send disinflation. We used to basically dread weakness of the yuan. Because obviously of the fact that it's a big disinflationary shock for the world. But at the moment, this might just be the cure we need. And, we're not talking about like 10%, but I think 5% would be already going a long way to help soothe, demand and purchasing power in the US.
Yeah, I think it makes sense. A weaker euro, a weaker RMB, and then the weaker yen. I mean, we haven't had a weaker yen like this, for a long time now. And at the margin, I think this all helps. Doesn't help emerging markets, obviously. They get totally screwed in this, high import. If they're not commodity producers, they're dead. Yeah. And we've seen that with Sri Lanka and a bunch of these countries.
And that's the other issue as well that we haven't talked about, QT. Because obviously, the strong dollar is not a free lunch. As we both know, money shrinking has already happened. It's already in the cards. And, you add dollar strength to that and you basically shrink global liquidity even more, which could be, basically stopping the Fed right in its stride a lot earlier than, what's currently priced in. I think there's a lot of uncertainty around what QT will be doing, especially in a world where, the dollar is like basically, potentially 10% stronger as well. I think that could be quite drastic. Again, I think it could happen quickly. And I'm not really willing to put a date on it, on a month or, but when it happens, I think that will stop the Fed right in its stride on hiking.
Yeah, it feels, the dollar is the macro daddy of the whole thing. It's the thing that rules everything. And I think you're right. I think that the dollar strength, it's weird because we're talking two things here. People are going to get confused. We're saying dollar strength is bad, dollar strength is good. It's kind of like the dollar strength causes a slowdown because it's a massive tightening of monetary conditions for everybody. Yeah. But the weakness is what we need to lower the inflation numbers. So it's kind of, I know it's confusing for people, but it's kind of the medicine everybody has to take.
Yeah. Ideally, you would have like a synchronized world where, basically rates go a lot higher and the dollar wouldn't have to strengthen that much. And that would be my ideal world. And we would just get a slowdown, then bounce straight away. Unfortunately, it's not what's happening because of the, war premium, war in Russia, massive issues with like Europe being criminally reliant on fossil fuel from Russia and gas. But yes, so the dollar is ideally you wouldn't have the strong dollar, and that's definitely a negative thing, but a negative that's got positive in terms of like purchasing power in the US and potentially getting demand to bounce.
Any other trades that you're looking at? Long dollars, looking to buy equities into sell-offs, looking to buy bonds. That's your structural core view. Anything else that you're looking at?
It's sort of like going back to, slowly into sort of like risk parity, right? Buying bonds dips, buying equity dips as well because they're cheap. long dollar. I mean, that's already a lot. I think, there is huge uncertainty on the outlook, amazing opportunities for trading. But in terms of the real underlying trends, which, I'm happy to talk about in an interview, I think, it's already quite decent conviction rather than. One thing I've been looking at is, when we said the US is much less vulnerable, in terms of like households than it was 10 years ago, or even like 2 years ago. US is really strong. Two countries where it's not the case at all. They kind of like buck the trend. Is Australia and Canada. So I've also been recommended like long dollar CAD. I think, if rates continue to go higher, I think the first places where we're going to start seeing cracks, beyond sort of like commodity trends and purchasing power, I think it's going to be Canada and Australia. So it's worth keeping an eye on home housing there and consumption there, because it will give us a head start in terms of what might be happening in the rest of the world.
I'm also thinking that, and this is just an early thought that I've been having, that, I mean, everybody thinks oil goes to $150, $200. And I'm wondering whether the strength of the dollar, some of these kind of big macro factors might actually stop that happening. And actually we could get, even with the Russia situation, we could get some of that premium come out. So let's say oil comes back down to $80. I mean, that's not what's in most people's forecasts. How are you thinking of commodities?
So I think in terms of energy, the vulnerability is more like gas, not gas, rather than oil. I think on oil you could actually manage to cut Russia out, and probably they would be like starting to sell to China or Asia. So you'd kind of like divert things. So I don't see much of, I think oil could be just a short-term supply shock due to basically, you have less gas, you need more oil. But I think you could very well be right that, oil goes a lot lower on demand destruction in the next few months. And that totally could be on the cards. A move to 80, I would very much agree with.
Yeah, while gas is stickier because of the issues in Europe, I guess, I mean, the US and Canada, everyone's going to divert as much gas to Europe as possible. Yeah. So we'll see whether there's a balancing effect there or not. The market's assuming not, but let's wait and see. Look, Juliette, fascinating to chat to you. It's a really complicated macro world.
Very, yeah.
And there's so many unknowns because, most of us tend to ignore geopolitics because it's a red herring. And for the first time in a long time, we're having to deal with it. And we don't know what's in Putin's head. We don't know how this is going to play out, which makes it really hard. But, it's fascinating to get your perspectives on all this. So thank you.
Almost makes you feel in going into politics, right? Because you want to be changing the world. When you start looking at geopolitics, you're like, you know what, I can make a difference. I mean, it's fascinating to have like every year something different to deal with. As some say, last 2 years we were doctors, and now we're like politicians and trying to, but yeah, love my job.
Fabulous. Juliette, as ever, fantastic to speak to you.
Great speaking to you too. Thank you for the chat.
It's a really complicated world out there. We've got massive inflation, recession fears, war in Europe, COVID, China issues. What the hell's happening? Everyone's got an opinion, but who's right, who's wrong? As co-founder of Real Vision, I've got my own view, but maybe I'm wrong too. And I want to go and find out more from real experts, real in-depth analysis. And I've hand-chosen my experts for this 2-week journey of discovery in global recession. Is everyone wrong? I've chosen people like Peter Zeihan to talk to him about geopolitics, David Rosenberg about the economy, and Pierre Andran, the world's most famous energy trader, about how to navigate the oil markets and where it's all going. This starts on May the 2nd, and I'm going to learn so much about what really is going on and how to best navigate it. Yes, not everybody's going to be saying the same thing, but it's going to allow me to piece together an investment framework to navigate these complicated times. Now, normally we'd give you 7-day trial for $1, But because this is so important for all of you, and I think it's one of the most important pieces of content we've ever done, we're extending that free trial for 2 weeks for $1. So you get the entire campaign of all of these great minds. And it's only $1 for all of this. So just go to realvision.com/global recession to find out more and join me as I try and figure out what the hell's going on.